How's it going, everybody? Welcome to another bootcamp video. I apologize again in advance for my voice. I'm still recovering from whatever this is. I can't even talk in my real voice without sounding like that. So I kind of just have to talk in this kind of tone. That's the only way the sound is going to come out, and it actually sounds a little bit audible. So you guys are just going to have to work with me. And like I said, there's probably going to be some cuts in the video. If I have to cough or clear my throat, I'll cut that out. So what are we learning about today? Today we are learning about fair value gaps and inverse fair value gaps. Now, what is a fair value gap? Well, in order to know what an inverse fair value gap is, we have to know what a fair value gap is. A fair value gap is a series of candlesticks. It is a candlestick pattern. Let's do our terms. It is a let's define it. It is a three candlestick pattern. Now, if you're unfamiliar with what the term candlestick pattern is, it's in the name. It's essentially just a series of candlesticks, and this can apply to many different concepts, many different things in trading. But what we're talking about, we're going to be talking about fair value gaps. But essentially, it's just a series of candlesticks that make up an observable pattern that people can spot in the market. That price can do whatever it wants with it. If it trades to it, rejects off of it, anything like that is a pattern that we observe, we see, and we can typically take entries off of them. All right, so let me draw it out, make it simple. I drew it there, but I'll draw it back on here so it's simple for you guys. A fair value gap looks like this. It is a three candlestick pattern. It can be bullish or it can be bearish. It can be three up candles, it could be three down candles, it doesn't have to be all up candles and all down candles in order for it to be a fair value gap. It just has to have this. It has to have a space between the first candle's top wick and the third candle's bottom wick. There has to be a space. Now, what do I mean by that? Let's draw it out like this. So, you guys remember when we were learning about candlesticks, don't you? All right, it's gonna look like this. We have, this is the wick. Here, we'll do a little box like that. Let me make it simple for you guys, make it big. Like that. Then we have this once again, like that. Boom, now another body, like that. That's the second candlestick, pay attention. It's the second candlestick, like that. And then now we have the third candlestick. Now the pattern that I'm showing you here is a bullish fair value gap pattern. All right. Now it's pretty obvious, if you're asking, well, what does a bearish one look like? I'll draw it out for you guys as well, but it should be pretty obvious if it's bullish. It depends on the middle candle. The middle candle is what tells us if it's bullish or bearish. If the middle candle is green, or whatever the up candle color is for you, that means it's a bullish. If the middle candle is red, that means it's bearish, or whatever color your down candle is. So I'm gonna make the coloring a little bit simpler for you guys, so we can see this. And for reference, the first and third candlestick colors do not matter. They do not matter. Let's let this out. So three candlestick pattern where there is a gap between the first candle's wick and the third candle's bottom wick. Now let me fix this. Third from the first candle's top wick and the third, and this is bullish only. All right, now for bearish, a bearish fair value gap is essentially this. It's the same thing, where there is a gap between the first candle's bottom wick and the third candle's top, wait, that's going too far, third candle's top wick. There's a gap between those, okay? So write this down in your notebook. A bullish fair value gap is where there is a gap between the first candle's top wick. Remember, we're talking about candlesticks, the bodies, the anatomy, all that stuff. See, the top wick versus, oh, I forgot to add this, sorry. I to add that, oh shit, I forgot to add the wick for this candle. My Apollo, guys. So, it is the space between the first candle's top wick and the third candle's bottom wick. And we can observe this, well, top wick of the first candle, bottom wick of the third candle. The gap in between, the middle candle is gonna carry that gap, because we'll see. So what do we do with that now? Now that we know what it is, what do we do with it? We take our box and we mark it out from first candle's top wick all the way up to the third candle's bottom wick. There we have it. That is a fair value gap. This is how we can spot a fair value gap in price action. Okay, now I'll give you guys an example right here so you can see. Don't even worry about anything going on. Just look at this. Up, up, up. Okay, that doesn't matter though. Only the color of the middle candle is what matters. So this first candle could be red, this third candle could be red, could be green, this one could be red, vice versa. But whatever the middle color is for the candle, that is going to be if it is a bullish, or you'll be able to determine if it's a bullish or if it's a bearish fair value gap. So pretty obvious, just like we marked out here, we can see right here, we take our box. So the first candle, we see there's a top wick, so we mark it out. Then we see there's a gap between this top wick and the third candle's bottom wick. There we go. That's our fair value gap. That's a zone. Okay, don't worry about what it does right now. I'll explain in a second. Just for now, understand that this is a bullish fair value gap. Why? Because the middle candle is green. And how do we know it's a fair value gap? Why? Because there's a gap between the first candle's top wick and the third candle's bottom wick. So now on to bearish fair value gaps. It's essentially the same thing. We can draw a little pattern here just so you guys can see. It's going to make it a little bit easier to describe, or sorry, just to understand. So I'm just going to make this red. Don't got to worry about the other ones. Like that. Oh, you like can't see that. Anyway, let me just draw this with the pencil. It'll probably be easier. Oh my god, I actually can't draw. Nice. Like that. There we go. So, same case scenario here. We have a candle. The middle candle is red, so a down candle, and the third candle is whatever color it is. So it's the same exact thing. We take our definition, we can see where there is a gap between the first candle's bottom wick. So first candle, we have it, the bottom wick, okay, there's a gap, so we're going to take our box, we're going to click, okay, now we're going to go here and we're going to see, it says the third candle's top wick. So we have a middle candle, obviously, and then there's a third candle, so we're going to look at the top wick, and then we're going to drag our box to make it into that zone. So that is our bearish fair value gap. So as simple as this. Bullish fair value gap is when the green candle is middle. When the middle candle is green, and a bearish fair value gap is when the middle candle is red. That these candles don't matter. This does not matter. Don't even worry about that. Now, some of you may not have a question about this, but I will just clarify. A lot of you will see a fair value gap start to form. Like you can see a fair value gap on any single time frame. Almost very often they form. They're one of the easiest things to spot out. So to clarify, some of you may be wondering, okay, well, what if the fair value gap is, looking like, oh my god, I got this box out of here. What if, I'll just do it. What if the, candle formation is that, is that technically, is that a fair value gap? No, because there's no gap. Why? Because the first candle's top wick is, there's no gap here. We see the first candle, so we can mark out the top, but then we go to mark out the bottom wick, and we can see, well, that doesn't make sense. There's no gap because the third candle's bottom wick is lower than this, and there's no gap in the body of the middle candle, okay? Now, to make another example, so we can see, not necessarily an example, but I'm going to delete these to just, well, delete them. We're going to spot some more on the chart. Like I said, this concept is extremely simple to understand. It's probably the most simple concept to understand, and it's just to spot out, right? We can see here, we're on the 15-minute time frame. We can see we can just take our box, we can turn on the magnet tool, we can turn on the weak magnet, especially because we want to be accurate with the boxes that we're making. We don't want to mark out a fair value gap, like, okay, the fair value gap looks like this. Okay, no, you have to be relatively accurate. So we can take our magnet, put on the weak magnet, and then drag our cursor to the first candle here. We can see, well, there's a candle here, and then there's another candle that goes up, and then the next candle following that, the bottom wick makes a gap from the top wick of the first candle. Okay, so now that's our fair value gap. That's our box. That's the zone, right? Here there's no fair value gap here. Nothing going to see. Oh, there's one right here. And oh, good, perfect here. Perfect example. What if the next candle doesn't have a wick? It doesn't matter. It's still a fair value gap. The first and third candle, if it doesn't have a wick and there's still a gap like that, it is still a fair value gap. It is still valid, okay? Now, we'll look at some bearish examples. It's the same thing right here. We have a candle, okay. The next candle, okay, it's a red candle, so we can assume it's a bearish fair value gap. We can see first candle's bottom wick. Take our box, click. Then we go to the third candle. We see, okay, we'll look at the top wick. Oh, there's a gap. There's a fair value gap right there. Awesome. We spotted it. Same thing here. We can spot, I can spot out like dozens of fair value gaps. Here, one. Right here. Right here. And I'm going fast, but it's this simple, guys. There's fair value gaps literally everywhere on any time frame. They're unbelievably easy to spot. And without further ado, I'm going to teach you guys how we actually use these fair value gaps. All right, so remember how yesterday's video or the previous video of the bootcamp we were talking about liquidity? Well, this ties in with liquidity in the market. Why? Because a fair value gap is essentially a zone of price, like we marked out, where price can go trade into that zone and then either continue, it's a continuation, or it can inverse it, inverse fair value gap, and continue the other way or from a reversal. And it helps give us a good idea if price wants to continue in one direction or keep going down or just chop and yada yada yada. So let's look at an example. We can see an example on any time frame. Like I said, it's unbelievably simple and easy to find. So actually it'll probably be easy if we scale down a little bit. We can even go on the 1 minute, matter of fact, because there's quite a lot of them here and they're good to look at. So perfect example right here. We're on the 1 minute, we're scaling down, okay, 12, 20, whatever. We can see here, there's a pretty big fair value gap right here, right? We have first candle, bottom wick, then the third candle's top wick. Okay, that's a fair value gap. So if we're looking to take a trade somewhere at this time, and we're like, okay, I want to see a continuation of price. I want a continuation of shorts. I want a continuation of bearish price action. We can see here, okay, we start to not fill in the fair value gap, and you can see as we don't go to fill it in, as it takes some time, we start to chop. We start to slow down, okay? Start to go up, chop, go back down, reactions in any kind of way, okay? But we notice that if we take our fair value gap and we stretch it out, we can see that price continued, chopped, and eventually came back up, traded into it, and pushed back down, and formed a new low. That is the valid idea of a fair value gap, is price creating an imbalance zone where price has not traded to yet. It makes an imbalance. We eventually trade into it, and it could be right after. It could have been, matter of fact, it could be the next candle. You see, this candle could have literally just wicked into it and then come back down, and that would have been the fill. But because we didn't do that, for most of the time, price is going to slow down and eventually go back into it and continue it. Now, it is extremely important to know that fair value gaps are aligned with your bias, with which way you want to see the market continue. Because otherwise, if we just take every single fair value gap that presents itself, we're going to lose trades, right? See, we go here, we fill in this fair value gap, we get a bearish reaction, we take a short position, we go down to this low. Awesome, it would play out, okay? That's if our bias was bearish. But we can see here, hold on, wait, Oliver. There's a really big bullish fair value gap. Did we go into it? Yeah, we went into it. We started trading upwards. Okay, I'm gonna long here, okay? Oh, but how come this long didn't work? We traded into it. Why? Because our overall bias was bearish. If we're looking for shorts, we want to have direction when we're trading for value gaps. If we don't have direction, if we don't have a sense of where we want price to go based off of other factors that you guys are going to learn as well in the boot camp, then fair value gaps are of no use to you pretty much. If you just take trades blatantly off fair value gaps with no context, you are going to lose majority of the time. Okay, maybe you get lucky, maybe you win once or twice, maybe I don't even know. But all I can tell you is that you're not going to be profitable if you're solely taking trades just off of fair value gaps. So another really good example of how we can use fair value gaps to our advantage is for our bias, as I just said. If you're not unfamiliar with the word bias, our bias is essentially when we get onto the charts, when we get onto the market, our bias is our, it's what we think price is going to do for the day. It is which direction we think price is going to go for the session. So if I'm getting on the charts at 9:20 a.m. and I'm looking at the charts, I'm looking, if there's fair value gaps, draws in liquidity, what price did overnight, I am developing my bias. I am developing a idea of where I think price could go, and I want to aim to take a trade in that direction. And our bias can usually be one of the strongest things and determining factors if we're going to take a successful trade or not. So a perfect example here, absolutely amazing example, we can see since August 14th we have had this really big downtrend, right, on the daily time frame. And as I've explained before, the higher the time frame, the higher the value of whatever you're looking at. So we can see here fair value gap, we can see bottom wick of the first candle, then top wick of the third candle. We mark it out, we drag the box however long, and we can see awesomely here, bro, this entire time it's like that example that I showed you on the 1 minute. We form the fair value gap, cool, okay. Now what does price do? Price continues lower for some time, and it's continuing lower, but it's having heavy zones of, it's like it creates a gap and then it goes down, but then it goes back up, and then you're like, crashes and chops for a little bit, then goes back down, then has a really big retrace, then keeps chopping, then expands back up. And we can see price slowly starting to shift structure to want to go up, to want to trade towards liquidity. And why? Because there's liquidity in fair value gaps, and I explained liquidity to you, which liquidity is what helps drive the market. It's not what helps, it's what drives the market to go in certain directions. And we can see an amazing example here. Scale down to the 1 hour, it's a little bit. So we can see here that, awesome, we have a daily fair value gap. Today's price action. What does price do today? We accumulate, we manipulate this low upon market open. Don't worry about what that means. I'm just, listen. We go, we trade into the fair value gap, and we start to get a bearish reaction. And what do we do immediately after we trade into that daily fair value gap? We absolutely sell off almost 1% in the span of, like, bro, we sell off literally 1% in not even an hour. In 45 minutes, we sell off 1%. Why? Because we tapped into that fair value gap. Why didn't we sell off here or here or here? Why? Because we didn't have enough liquidity to make such a sell-off like that, which is why I emphasize on telling you guys that the higher time frame holds a lot more value than lower time frames, which is, I say, you look at the daily fair value gap, like, this is a great zone to trade to. It's as simple as accumulation, manipulation, distribution, okay? So another example we can see even on the monthly time frame. There is a monthly bullish fair value gap here. We can mark it out. We can see price traded into it right here. What do we do upon trading into it? Literally the next candle, the next week we rip up. We rip up like that after trading into it. Okay. Same case scenario here. Here we end up closing into this fair value gap, and now we're developing pretty slow. So you might be wondering, Oliver, how come this isn't shooting up? Fair value gaps do not have to work each and every single time, and although I do emphasize that the higher time frame holds more value, which is 100% true, fair value gaps don't have to work all of the time, and we can see fair value gaps getting inverse, which is now we're going to talk about inverse fair value gaps. So I'm not going to bring back the drawing of the fair value gaps because you already know what they look like, but an inverse fair value gap is essentially when price, okay, we have a fair value gap. It is when the candle that is sort of trading into the fair value gap closes below the gap. That means it gets inversed, okay? Now that indicates either that price is not going to use the fair value gap and it's ignoring it, and it's still like, okay, price, we're going to drive lower, so we're going to get inversed. Because if price were to respect the fair value gap, trade into it, and expand back out of it, it's probably going to do it in a fashionable manner of going into it, getting a relatively good candle close, in this area, preferably closing above it. That is a good indicator that price it got its liquidity and it's ready to drive back up. But if price completely goes past the fair value gap and closes below the box that we created, it's most likely we can anticipate a potential reversal. We can anticipate price to no longer go in the direction that this fair value gap was formed. And we can see, perfect example, we have a higher time frame fair value gap. That this daily fair value gap helps with our buys. See, we trade into the daily fair value gap, so that's a lot stronger. So a lot of people right here are like, you could be, oh, this is a 15-minute fair value gap, we manipulated this low, this is going to be a super strong, as soon as we trade into it, I'm going to take the trade. No, because we have a higher time frame fair value gap that holds higher value wherever driving price into a certain direction. So if you had long off this fair value gap, sorry, but you're pretty stupid, because this expansion move that we had here was trading into a daily fair value gap, which we know is going to hold a lot more value than a 15-minute one. And we can see here another entry is that we have the fair value gap. What do we do on the next 15-minute candle right here? We go into it. We don't even bother trading into it and pushing out. We literally fly past it and close below it. Now listen, if the fair value gap, if the next candle is like this and it opens, and say it closes like right here, okay? Say it closes at this level here, it goes like halfway into it, and you're unsure. It's like, okay, well, we didn't push out of it, but we didn't do this. Always want to be patient. You always want to be patient in waiting for your fair value gap entries, because price can easily go into the fair value gap and it can just sit there. It can chop and then it can eventually expand, or it can sit there, close, get a weird close at the middle, and then still expand upwards or continue down lower, okay? We are not the drivers of price. We're simply reacting off of what price does. However, it is a lot higher probability of a fair value gap working when it closes above the 50% range. Remember yesterday how we were talking about the discount, the premiums and the discounts, the 50% range of a box, and that applies to fair value gaps. We can see that's why I have a little line here, because when I mark out my fair value gap, we can see that we trade past the 50% range and we close below the 50% range, we close below the entire fair value gap. So that completely disrespects it, the idea of a bullish reaction from there. But we can also see that the 50% range is a discount. So we mark it out like that. We can even take our Fibonacci tool if you want to make like that. We mark out the fair value gap with our Fibonacci tool, and we can see that if price can, most of the time, if it wants to expand off of it, it's going to go into it. It's going to trade into it. Maybe wick past the 50% range for equilibrium, for a discount, and then get a body close above it, because the body close is going to help us indicate, exactly where price is at the moment on a lower time frame, and just give us a better idea of where price wants to go. So we can see if it were to trade into it like that, as a wick right there, and we can see that the body closed anywhere in this range, for a matter of fact, anywhere in that range. That is a better indicator that price is most likely going to continue in the direction that the fair value gap was formed in. Okay, these are extremely simple concepts that we can see on every single time frame. Matter of fact, here, or we can look on the 4-hour chart right here. We have a really big fair value gap. We can see perfect example. Look at this price. What it does, makes a really, really big fair value gap in 4 hours. What does price do? It accumulates, then it goes down into the fair value gap. It trades into that zone, doesn't even touch the 50% range, which mostly can be good. We get a body close above 50%. We, wick well into it. Then what do we do after that? We make a new high, right? You're wondering how come it isn't expanding, millions of points higher? It doesn't have to. All it has to do for the fair value gap technically be valid is just take out the high that, the swing high that was created, or the swing low that was created to drive price lower, right? And we can see this is beautiful, right? You could have longed this. You could have longed this for value gap, right? You see, okay, well, I trade into it. I don't want to see price maybe go below the 50% range. I can target this high right here, and boom, it traded back. I won my trade. Why? Because I saw a really big fair value gap. I traded into it and expanded back out of it. Awesome. And we can see here, hold up. We got a 4-hour gap here. What happens at the 4-hour gap? We start selling off. We get a body close here. Body close really close to the 50% range. And the next body close inverses that 4-hour fair value gap, proving that that gap is no longer valid. Not necessarily, I want to say no longer valid, but it's most likely no longer going to be of use. It's no longer most likely going to shoot up as if it would, like it did here. So we can see, simple as this idea. You can even short this, bro. Put your stop at where, I don't even know, wherever, bro, and just go target Narnia lows. And you could have taken that 4-hour, you could have done swing trading, right? Could have taken that, could have sat in that. You barely would have had to take a drawdown, bro. Would have got in that trade, boom, straight to TP. Why? Because we inverse that 4-hour value gap. That is most likely going to indicate a reversal, or just that the fact that price is not going to shoot up after it or shoot down. And like I said, we can see this on so many time frames. It is insanely effective. Another perfect example here. We have a really big range. Boom. Have a nice little fair value gap right here. Absolutely beautiful. I mean, fuck. This 4-hour candle trades into it. Goes right below the 50% range to grab that discount. Closes amazingly above it. Then what do we see after? Rally. Okay? Expansion. Fill fair value gap. Rally. And the way I like to explain fair value gaps in the sense that it's like energy, because a lot of people will like understand fair value gaps and they'll see them on the chart, but they don't really understand like why it's driving the market. And I like to think of it as just like human energy. Think if you're doing, sessions of sprinting, right? You're at the park, you set up a cone down, you put a cone down, and then you put a cone down like 30 meters or 30 yards or wherever over there, and you do sprints, right? The reason why you set those cones is because if that you continue to do sprinting like that, you would probably faint and probably fall. If you were just continue sprinting, eventually you would fall, and it just wouldn't make sense. We don't do that. That's why you put the cone there. So why? You sprint as really hard as you can. We can imagine this bullish uptrend as a sprint, and then as soon as you get to the other cone, which would be like this little point right here as we start to pivot downwards, but because we did all this running, we need more energy. And how do we get energy? By stopping, by slowing down, by not necessarily going the other way, but in trading terms, by walking the other way. And we can see that with the fair value gap. So if we want to keep sprinting, we're going to need to take a little break. We're going to need to take a break from the expanding. We're going to need to sit down. We're going to need to start going down. And we can analyze these zones of expansion as a fair value gap. So it's like you're sprinting at the park, you sprint your 30 meters, then you start to slow down. Okay, we slow down. Then eventually we got our energy back. Okay, we have all our energy here. We go back up. We go for another round of sprinting. It is that simple, that easy as understanding fair value gaps, okay? And then, fuck it, I don't even know. Inverse fair value gaps can just be when you are done sprinting. And that's exactly it. Inverse fair value gaps can be, look, oh my god, it's a great example. We did our sprint. Okay, we rested. We did another sprint. Okay, now we're done. We're going home. We are not doing sprinting for a while. And how do we know that we're not doing sprinting for a while? How do we know that we're going home for the time right now? We can see fair value gap gets inversed right there. What does it do? And now all this right here is us resting at home, okay? And then it can be vice versa. I don't want you to take this example just for bullish fair value gaps. We can see the same thing happening, you know, right here. We can see this. This is we're sprinting right here, okay? We have a fair value gap. I guess we trade into it. This is us slowing down. This is our water break. And then we can see immediately we start to shoot down back into it. We're back into sprinting. We're back into full sending it. And is that quite that simple? So that is legitimately it for fair value gaps. I know you're shocked. I know you're shocked at how amazingly simple this terminology and everything is here. I mean, bro, look at this sexy ass fair value gap right here. 4 hour fair value gap right here. Oh, trades into it. Look at that body close. That's beautiful. So that is it for this video. Like I said, stop trying to put everything I tell you into context immediately. I'm gonna help you put everything that I'm teaching you into context eventually when the time comes in one of the bootcamp videos where we start putting everything together and it starts to make sense. But as I said, just keep everything simple. I want you to draw out the fair value gaps in your homework for today. Literally just go on the chart, any single time frame, preferably a higher time frame, just, you know, so you get confused a lot, because we can notice that on like the lower time frames there's going to be a lot more fair value gaps, a lot more stuff that doesn't get respected. You don't want to confuse yourself, so I would recommend staying on like the 1 hour fair value gap sort of time frame. And then from then on, literally for 10-15 minutes, just go out there, start marking out fair value gaps and see it traded to it. Did it go how were the body closes? Did it inverse it? And see what price did after. It is that simple. So make sure you do that as your homework, otherwise you're an idiot. I'm kidding. I love each and every single one of you guys. So that is it. I'll see you in the next video. Hopefully you understood this. Make sure you can drop any comments below if you have any questions, or shoot me a DM on Discord. The link is in the description. Completely free Discord. So that is it for this video. I will see you guys in the next bootcamp video, and peace.